Good morning, everyone. This is Neil Sperling here at Financial Markets. Thanks for joining us today. To the producers that we work with in Texas and Louisiana, we sure hope you're staying safe, and we wish you the best as you ride out the storms. Hey, we're going to have a great presentation today. Rather than just talking about a product on the shelf, Regional Vice President Kirt Nolde and Senior Internal Wholesaler Dana Brown will be sharing some real-life designs that you can take home and use in your practice. During the call, your line is on mute. Should you have any questions you'd like to enter, use the GoToWebinar control panel. Type those questions in, and we'll get those at the end of the presentation here today. At the balance of the presentation, we're going to have a drawing for a $50 Amazon gift card. You do need to be present for the duration of the webinar and on the call at the time of the drawing to be qualified to win. So with that, I'm going to turn this right over to Kirt Nolde. Go ahead, Kirt.
Thank you, Neil. I appreciate it. And thank you to everyone who's done business with Protective over the years, and we appreciate all that business. Today, I'm going to talk to you a little bit about a couple of strategies that we have that are, sort of available and stuff through Financial Markets. And they use a few of our features that are kind of unique to Protective. But before I get started, I thought I would just talk a little bit about a couple things that are different, this year. And the way I like to think of life insurance planning is I kind of relate it to my golf game. And this year, for the first time, I'm off the road in 25 years, and due to the way everything's working out this year. And I've been able to focus a little bit more on my golf game in the evenings and on the weekends. And I've lost 20-some pounds because I've been home. So a lot of things are better from being on the road. And all these years of being on the road and traveling, it made me go from a preferred elite, preferred immortal life insurance risk to a standard risk. And maybe I might even have to bribe an underwriter to get to there. So a lot of that stuff has been good for me, is starting to get more healthy and work on my game. And part of the things about working on my golf game was that I needed to go and break things down. I wanted to go from a 4 handicap to a 0. And that's a big jump. For those of you who are golfers, you know that you can go from an 18 to a 15 or a 15 to a 10, and it's a couple of lessons, a little bit of work, and you can kind of make that jump, and it's not as difficult as it gets when it gets closer to the 0. So that is a very big jump that I had to do. And to do it, I had to really look at a lot of things and change, go through a lot of work with a swing coach, and I'm working with another guy on a short game, and I'm trying to get it all the way, everything really honed in. And there's every little part of the swing that I had to work on, from takeaway to setup to transition at the top to how I rotate. And I had to work on, I've added, at least a dozen new short game shots and chips and pitches and techniques around the green to deal with different lies and stuff. And the way I like to think of life insurance planning is kind of like my golf game. You got to go through all the work with all the little different techniques and stuff that are out there to get better. And if you don't kind of focus on one part of the techniques, everything can kind of break down. And I think that would be the way to think about what we're going to talk about today. Is in the financial planning world, you have a lot of options available for you, and a lot of stuff that's out there that you can look at and find ways to plan for your clients. And this way today is going to be another way of looking at some of these scenarios that you run into, where clients basically have a need for more death benefit. They have old whole life policies, typically from mutual companies, or cash value or variable life policies that have cash. And what can we do on some of those scenarios? And this is a good scenario because it really kind of fits for me, myself, and what I'm looking at doing, the same sort of thing, a split 1035, for all the reasons that I'll go through with you. Today, I'll talk a little bit about the 1035 exchange problem. So if you're going to 1035 that money over there is some problems with 1035ing. It kind of can affect how much death benefit you can get for your clients. And we'll talk about a unique solution that's unique to Protective. And then we'll talk a little bit about how you find these potential cases and why they're out there, and they're very lucrative for you, but they also are doing the right thing for your client. One of the things that you run into when you're looking at some of these, trying to do policy reviews and see if you can find a way to make the policy a little bit better for their clients, is sort of the sticker shock. A lot of times these clients are 10, 15 years older, and as you know, life insurance becomes more expensive. Their health might have changed just as mine has over the years. And you're looking at there's a little bit of a sticker shock, and it can stop a lot of these things from happening. So it may or may not work. Sometimes it's close. It doesn't quite work. It's a little bit better, but maybe not enough to make a move. And this scenario today is probably going to go through, is going to go through a few more ways of where you can look at this, and you might be able to save or solve some of these issues for your client. So the problem, let's examine the problem a little bit of 1035 exchange. Limmer did a study recently, and it showed that the number one reason that people buy life insurance is for income replacement. And the number two was for burial and final expenses. And then the rest of it sort of split up amongst legacy planning and estate planning and taxes and business planning, special needs, all the other reasons that you can buy life insurance. And there's all these other reasons for it. But one of the key features that everybody's looking for in life insurance is chronic illness care or long-term care expenses. And we're going to address a little bit of that in a second too. So when you start looking at a lot of these scenarios, when you're looking at an income replacement, that's a short-term need. And when you look at the other reasons for life insurance, those are more permanent needs and permanent sale. And if you have a need for income replacement, you cannot 1035 into a term product. Well, then we have a solution for you that works really well, and it's the Protective Custom Choice UL 10 through 30. So because it's on a UL chassis, it has increments anywhere from 10 to 30 that you can set the policy up with. And it's a UL policy that acts a lot like a term policy. So for example, if you took a 20-year, made a Protective Custom Choice UL 20, it's like a 20-year term. At the end of that 20 years, the policy death benefit starts decreasing, but the premium remains the same. So it acts a lot like a term policy, and with a little bit of a unique feature at the end. And the other unique thing about that product is because it's on a UL chassis, it's the only one out there in the industry, it can accept 1035 exchanges. So we're going to show you a couple scenarios where it makes sense that you might want to put some of the cash value of a 1035 into a 1035, or into, a term product. Who is the target audience for this client? It's for you guys. It's if you're doing any kind of policy reviews and performing any looking at some of these old policies, that is definitely the people we're looking for here. And also, if you have clients who have cash value life insurance, we're looking for those also. And then we're also looking for people who are, needing more income protection or more death benefit now than they currently have because they're in a higher income earning phase. The clients, what we're looking for, sort of our target clients, are the ones that are still in their income earning phase, but they have a definite need for more death benefit. And it really helps that they have these cash value life insurance to make this work. So we're looking for the ones that have had the old Mass Mutual, Northwestern Mutual, some of those companies like that that are out there. They're very good policies, but as the years have gone on, maybe the dividends aren't paying as well, and they might not be performing as well as they originally were sold. And you run into a lot of these scenarios out there, and I'm in that exact same scenario, with my wife's policy. So we're looking at doing this sort of concept with my wife, and we're kind of going through this, and it really works out real well for us. So let's take a look at the first scenario here. This is the scenario we had that came in. This is kind of where this idea came from, through some of our partners, like our partners at Financial Markets. Matt was a male, age 50, and he was preferred non-tobacco. He had $125,000 of income when he first bought his policy. He was in a much lower income bracket, but he's been funding this thing with ongoing premiums. It has about $800,000 of death benefit and about $200,000 of cash. So we just kind of rounded those numbers. That's his current situation. It's a good situation. If he were to die, he'd probably get 5-6 years of income replaced. He does have some cash in there, so it's not a bad policy. He's not in a bad situation. But let's see if we can make it a little bit better. Because when we talked to Matt said that he had a few concerns and needs that he's looking at. One of them is that he wants more income replacement. And generally, he can qualify for about 20 times his income. So if he's 50, we're going to try and get him out to about age 70. That gets him 3 or 4 years past his retirement age. And it gives him a little bit of a buffer in case he works a little longer or needs a little bit more income replacement in the first part of retirement. So he really needs about $2.5 million of death benefit coverage, and he's at $800 right now. So we're looking to either add maybe 1035 this and replace that income. We can do a lot of other things with it, but now we're trying to figure out what we're going to do with this scenario. And he doesn't really need the cash value, but he really liked that option. Once clients have cash value, they feel like they don't want to give it up. So they do kind of look for, can I keep that cash value around? And probably his biggest concern now becomes the need for more income replacement. And with him, it was also he wanted that chronic illness care. He's getting older, and he sees his parents are facing that situation where at some point they may be needing to go to a nursing home. And I'm looking at the same thing in my scenario, and you start realizing that it's probably something that's more important than even income replacement as you get older, is trying to make sure you have the chronic illness care and some stuff available to help you when you get to that point. And that's where he was looking at for his scenario. So what did we come up with here? So if we looked at the first scenario, this is typically what happens in a lot of these sales, is they take their original policy, they look at it and say he's got $800,000 of death benefit, $200,000 of cash, but he does not have chronic illness on it, and he does have ongoing premiums, so he's still paying for this policy. So can we make this a little better? So first thing we did is we put it into our Advantage Choice. And if you see, the death benefit's a little bit more. It's not much difference in the death benefit, so we really didn't fix his income need. It had an age 95 guarantee, so it's going to be guaranteed out to age 95 with just using a single premium. We're not going to add any more premiums. That's one of the advantages that we're doing, is we're just 1035 this over and using it as a single premium policy. It basically will give him $41,000 of income replacement, or it'll give him about 6.5 years, where he's at currently. It's not much better than what he has. It's about the same. But it does eat up cash value because it's in a GUL, so he's losing his cash value. But for that, he also gets our Extend Care rider, which he's going to be able to get $11,400 a month out of, and that's the per diem max right now currently. And we did not no ongoing premiums. So when you look at these two side by side, this is really not a bad scenario. We did make things a little better for him. We didn't get any better in the death, and we didn't solve his income need, but we did add the Extend Care, and we did eliminate premiums for him. So that's not a bad option right there. Now let's look at another scenario. Matt's option 2. Protective is another thing that's kind of unique to Protective, is that we can allow you to 1035 some cash over. You had $200,000 of cash, and we can allow you to split it once you get it over to Protective. So if it's in another carrier, they 1035 to Protective, and then we can split it up into a couple of policies once it gets over here. And in this scenario, what we did is we took, and that's not unique to everybody, but doing the 1035 into a term product really does work well for us, and it is unique to Protective. In this scenario, we took $77,000 and put it into our Custom Choice UL, Term UL. We bought a 20-year policy, which gets him past retirement out to age 70, and we got about $2 million worth of death benefit. And then we took the balance of the 1035 over here, then $120,000, almost $123,000, and we put that into our Index Choice, which is our GUL. It's an index product that has guarantees. And I like to call it a GUL with indexing strategy, because it has really good death benefit guarantees and builds some pretty good cash in it. So when we looked at this scenario, it bought $736,000 of death benefit. It was guaranteed through age 81, but at the current assumptions, it ran to age 107. So there's a little buffer in there. If it earns a little bit more than what we illustrated, it might go a little longer. And we've got to increase his death benefit to $2 million to $2.7 million. So we've covered his income need. And because the income replacement is a short-term need, we used our short-term solution to Protective Custom Choice with part of it to solve that. And then we have this policy going forward. That's one option. And the other thing that we did add is we added the Extend Care to this policy with no ongoing premiums. So in this option 2, I think we've made it a little bit better. But now the question comes up usually as well. Age 81 is not a very good guarantee, and things can happen in index, and I would agree with you. So let's see what happens if we can find a way to sort of extend out that guarantee a little longer. So in this scenario, we look at his current situation. He has $800,000 of death benefit, $200,000 of cash, no chronic illness, and he has ongoing premiums. So what we did a little different here is we dropped the Index Choice death benefit. We still use the exact same Custom Choice product and the term solution. We're replacing $2 million of income, but we dropped it down to $553,000, and that gave us an age 90 guarantee. So that extended his guarantee out to age 90. It gave him a lifetime guarantee, and the non-guaranteed side. So on the current assumption, the current portion of the illustration, it ran all the way out to lifetime. And he also had some cash value. So he didn't want to lose that cash value. So in this scenario, we've got $273,000 under current assumptions in year 20. So we built in some cash value, and that could be more or less depending on what, how it actually performs. And I think we use 5.41 as the interest rate on this, which is not an aggressive interest rate for an index product, but you can use a little lower if you are more conservative. And the numbers change a little bit, but the concept still works very well. And we added the extend care rider on this. And here's the other keys: we have no ongoing premiums. So by taking the policy that he had currently over 1035 into protected, splitting it up into our index product and into our custom choice term UL product, we were able to take care of his, need for income replacement, his short-term need, and his permanent need, where he wanted a little bit more of the extend care, some of the cash value, and he also really liked the idea of not having ongoing premiums. So in this scenario, we made his optional much better, and he went for this. Now, when we were talking about this earlier, Dana and I, my internal, she's the best in the country, and I'll tell everybody that. She and I came up with another concept here, and what we thought about was, okay, since this is a bonus one for you guys, this is a option 4 that we're going to show you. Everything's the same over on the left. What we did different on this scenario this time was, because it's a income replacement, I don't think there's a better feature in the industry for income replacement than our income provider option. So the income provider option is an option that allows you to spread the death benefit out anywhere from 2 to 30 years. So for example, if you had a $1 million death benefit and you spread it out over 20 years, we're going to pay the death benefit out at $50,000 a year for 20 years, which equals the $1 million. Now, in doing so, it allows us to decrease the cost. Or for the same cost, we can actually increase that death benefit. We might give them $55,000 a year for 20 years. And that feature is really good for income replacement because it keeps the cost down and it pays it out just like they lost the income. So in this scenario, what we did is we took the death benefit on the custom choice and we lowered that lump sum to $62,000 from the $77,000 before. That bought us a $2 million policy, which is going to pay out in lump sum or in over 20 years. And then we took the rest of that money that we had saved by using the IPO and we put it into the index choice. That increased the amount of cash that was going in there up front. That increased the death benefit a little bit, gives him a little bit more death benefit. Still had the same age 90 guarantee and still have the lifetime guarantee, but it also increased his cash value. We still have extend care on it and no ongoing premiums. But by using the IPO with the custom choice, it really solves the income replacement need, and it gives us this policy that performs really well on the index side. And there's a lot of flexibility. And this is just one way we could design this. We could do a lot of things with this, and your partners at Financial Markets are the best at doing this. They can go and look at these policies, and we can go through a few scenarios and find what is actually best for your client and what they're looking for. Maybe we try and get a little more death benefit. Maybe we try to lower the death benefit and build a little more cash. Maybe what we're trying to do is extend out the IPO or not use it. So there's a lot of options you can do with Protective that are kind of unique to Protective that really give you a lot of tools in your tool belt. And the way that I think of it is, you guys are the golf coach trying to take someone like me and make us a better golfer. And this gives you a lot of tools and a lot of techniques to help them get better. And in this scenario, I think we saw that it really does make the client's situation a lot better. So remember that the solution to this, and what really kind of makes this all work, especially in the income replacement, is the low cost Protective Custom Choice UL 10 through 30. Because it'll allow a 1035, it allowed us to do this and really kind of leverage up their death benefit and solve what they were looking for. The other beauty about that index product is at some point in the future, it starts hitting corridor and that death benefit starts increasing. because on the current side. So we don't know exactly what it's going to earn over the years and how it's going to perform other than on the guaranteed side, which we guaranteed to age 90. But we do know that it has the ability that it could go a little bit better than what we actually need. I don't like to sell that, but it is out there, and it could end up with a lot more death benefit in the future. So a couple of action items that we looked at. How do we identify some of these existing cases? Well, we have to find cases where 1035 exchanges that you've currently done, something you've been working on the past 12 months, they can't have dramatic health changes, or it does affect how this performs. And we're looking for policy clients with cash value in their policies. We focus on getting the significant leverage. So if they're still in the income earning phases of it, we can really leverage up this death benefit. So I suggest you call financial markets to discuss this. You identify a few of these cases, and then make sure that we look at some of these. Now, a couple of the other places you can look at is income replacement loan and debt protection, retirement shortfalls. There's a lot of reasons why you might want to use a UL 10 through 30 in a short term through retirement. And we can go into a lot of them, but there's not enough time for all of that. But we do have a client approved brochure that I showed you earlier that we went through, and that you can use this with your clients to kind of explain this concept, see how things work, split up the policy however you want. In some of these contracts are protected, since we can split them once they get over here, and see how it works. So to recap, there is a problem with 1035 exchanges in that it doesn't usually address the short-term need, or you have to put it all into a permanent policy and pay a lot more cost of insurance to solve that short-term need, which will go away over time. Protective has a unique solution which allows you to use the UL 10 through 30 for exchange, and allows 1035 exchange funds. And in the past, if you find cases that haven't worked, or they're close and they're not exactly right, this might be an option for them. By using our custom choice and our IPO, it can really help you leverage up your death benefit sales. So with that, this is the real important disclosures here. Before I turn over to questions, I just want to say that thank you for all of the business you've done. And when you are out there, trying to coach your clients to, in my case, they wanted to be a zero handicap, but in your case, you're trying to coach them and teach them to get to where they want to be at retirement, so that the best options for their client at retirement and at death, and for transferring estates and taking care of their families. There's a lot of tools out there, and Protective has a pretty good portfolio allowing you to do some of these things with our riders and our features and benefits. Now, with that, I'll turn it over to Neil and see if there's any questions or anything else you would like to add to this.
You bet. Thank you. Thanks, Kirt. A lot of times when folks think of, or I should say producers perhaps, think of Protective Life, they think of you guys as a term company. Obviously, you guys have been ultra competitive in that space for decades, but really, one of the things to take away here is they have really nice permanent death benefit focused products. And they're one of the few carriers that offer an IUL that has a true no lapse guarantee. One of the things too with their permanent plans, when you stress test them with missing a premium or two, or having a periodic 0% index return, they fare much more favorably than other carriers in the industry. And when I say much more, it's a big gap. So when it comes to the duration of the guarantee and the non-guaranteed performance, if your client misses a premium, I'm not saying it's not going to affect the policy, but it's not going to affect the policy as dramatically as you see other products in the industry. So definitely think of Protective as a good place for death benefit focused protection permanent products. And that income provider option, how about selling an amount appropriate to cover the debts for the family, and then have the balance paid over maybe 10, 15, or 20 years. What do we know about lottery winners? Well, 3 to 5 years later, they're broke. And sometimes a big death benefit can do that to folks as well. Getting that nice monthly income stream off that death benefit might be something that would really help that family out in the long run, rather than getting a huge lump sum up front. And then, of course, your premium's lower for the same dollar amount of death benefit, knowing that you're getting it over a period of time. So thanks for sharing that with us here, Kirt. I don't see that we have any questions that have came in, so think we're in good shape there. Do you have anything to add?
Well, the last thing I'd say is you're dead right on the IPO, and I'll tell you for your clients out there, I'll tell you exactly who loves IPO, and that's the parents and grandparents. And do you know who does not like it? The kids, because they want it all for lump sum and to spend it just as Neil said. So this IPO has been very, very popular with grandparents and parents trying to, provide income to their kids so that they just don't blow through it on new houses and cars and vacations and all that stuff. So that's a very good point, Neil. I'm glad you made that.
And the IPO being the income provider option.
Correct. Income provider option. I should have said that.
We call it the IPO around here because we use it quite a bit, but it's just a really, really cool solution. And you know what the fact is, too, when you're talking with your client, occasionally you have some competition. I know you guys have good relationships with your clients, but having this option really differentiates you from any other company out there, having that income stream death benefit rather than that big lump sum. So really a differentiator for you. All right. I don't see any questions have came in here, Kirt, so you did a fantastic job. We're going to get on to the drawing. And also, folks, this call is being recorded, and so this will be available on our YouTube channel. Just go to youtube.com/fmiAgent. And also, if you'd like to get the ability to run term quotes and GUL quotes with Protective and our other companies, if you haven't yet, download the fmiAgent mobile app by just searching fmiAgent in the App Store. And so we'll draw for the one lucky $50 Amazon card winner. And let's see who it is. Right now you're hearing an imaginary drum roll. And it is Brad Gower. Let's see if Brad is still on the call here. And Brad is still on the call, so congratulations, Brad, and most importantly, thank you for doing business with financial markets and Protective Life over the years. We sure do appreciate you. Anything else to add in closing here, Kirt?
No, I appreciate the time. I appreciate you giving me the opportunity to speak with your financial planners and your agents.
Thank you, everyone, and don't hesitate to reach out to your internal wholesaler here at Financial Markets for a quote on one of these Protective products and concepts. Thank you, everyone.